I want to talk about simple return versus log return, these two concepts in this video. As I mentioned before, time series models can be applied to a variety of disciplines, such as financial analytics, machine learning, and artificial intelligence. Some people would like to use time series models for stock analysis. You can do that. But when you apply time series models to stock price analysis, you have to pay attention to some points. I want to talk about these points in this video. Before we analyze stock price, we have to figure out what exactly we are analyzing. It's very important. In practice, we frequently analyze two returns. They are simple return and log return. This chart shows an example of Apple stock prices. As you can see, we got a long-term trend, we got bumps and dips. Obviously, this is not a stationary data set. How can we get a stationary data set then? I want to challenge you a little bit. Think about your answer, and then I will share mine with you. How can we get a stationary data set on top of the non-stationary stock prices? I hear voices from the bottom of your heart. Some classmates say, let's do this. Instead of analyzing stock prices directly, let's analyze the percentage of stock price changes. Because the percentage of stock price changes are kind of changing in a range. Today, the stock price up by 2%, tomorrow down by 3%, the day after tomorrow up by 4%, and so on. As you can see, they kind of change in a range. If we visualize the stock price change percentage in a chart, the time series should be fairly flat. That fits the stationary data requirement. This is actually what we do when we apply time series models to stock analysis. Instead of using stock prices directly, we analyze the percentage of stock price changes. It's very tedious to keep talking about the percentage of price changes. So we create a new term, return, to represent the percentage of stock price changes. Finance people are very thoughtful. They have developed several types of returns, including simple return and log return. So let's talk about them one by one. Simple return. As you can see, the first equation shows you how to calculate simple return. We use uppercase R sub t to represent simple return. We calculate simple return in the following way. We subtract yesterday's stock price from today's stock price. We get this price difference. Then we use yesterday's stock price to divide this price difference we just get. This is how we calculate simple return. We can also get lots of variations based on the first equation. For example, if we move the value 1 from the right side of the first equation to the left side, we use 1 plus uppercase R sub t. We can calculate something called a simple gross return. Notice the difference between simple return and simple gross return. The simple return just measures how much you gain or lose every day. But the simple gross return measures the whole package. We have to take the original investment into consideration. Our original investment should be 100%. What if the simple gross return is less than 100%? Is that a good thing or bad thing? That's a bad thing. That means we are losing money from our original investment, right? The more we invest, the less money we have. But if the simple gross return is more than 100%, is that good? Yes, That means we are making gains out of the investment. No matter which simple return we are talking about, simple return or simple growth return, notice that the simple return is calculated according to 1 day price difference. So that's why we call this simple return one period simple return. Let's do some exercises to get comfortable with these new concepts. When you use these PowerPoints, please cover the answers at the bottom of this slide and then try to figure out the answers by yourself first. And then take a look at if you get the correct answer. I will list the PowerPoint slides down below. You can download from this video's description section. Since you get the answer on the slide, I will not repeat how to calculate. You just follow the equations we just talked about to get the answer. But I want to talk about some finance concepts according to this example. The first one is the difference between close price and adjusted close price. Close price is the price we can immediately see in the market when the market closes. The adjusted close price take dividends, other incomes, capital gains out of the close price. We subtract the dividends and the capital gains from the close price to get the adjusted close price. So which price should we use? It depends. If you want to make a short-term forecast, I would suggest you to use close price because that is the immediate price we can see. On the other hand, if you want to look at the long-term performance of a stock, then I would suggest you to use adjusted close price. This is the first concept I want to clarify. The second one is, if you take a look at the table, some people say we got missing values on December 19th and 20th. No, we didn't get missing values. The reason is December 19th and 20th are Saturday and Sunday. The stock market was closed. That's why we don't have price data for that 2 days. So how can we calculate this one period simple return? You just use December 21st minus December 18th, and then divided by December 18th. You will get the one period simple return of December 21st. The third point is we will write the return value in a decimal format. We can write it in a percentage format, but the percentage format is kind of annoying when we use the return value in time series models. So we will write the return value in a decimal format. These are the points I want to clarify. We can use the equation we just learned to develop the K-period simple growth return. Simply speaking, it's a multiplication of one period simple growth return for K days. The equation on this slide shows everyone how to calculate the K-period simple growth return. Notice that bracket K does not represent a subscription. I want to use bracket K to represent how many days of a simple growth return I want to look back. If I want to calculate the 2-day simple growth return, then I will replace K with the value 2. If I want to calculate 10-day simple growth return, I replace K with the value 10. Let's see an example. What is the 2-day simple growth return on December 21st? Since I want to calculate 2-day simple growth return, I will replace K with the value 2. And then I calculate the simple growth return of December 21st and December 18th. And then I will multiply these two values. I will get the 2-day simple growth return of December 21st. Then we have something called a log return. A log return is basically the logarithm value of the simple growth return. To differentiate log return from a simple growth return, we will use lowercase r sub t to represent log return. we can calculate 1 period and k period log return, as you can see on this slide. When we calculate the k period log return, basically, we are transforming the product of simple growth return into a sum of 1 period log return, as you can see on this slide. This shows the purpose of log return. Log return is not difficult to calculate, but many people have a question about why we need the log return. Here's the reason. According to what we learned in the statistics class, the product of normally distributed variables is not normal, but the sum of normally distributed variables follows a normal distribution. Between simple growth return and log return, which one is a product? Which one is a sum? Let's go back to the previous slides. The k period log return is actually a sum. But if you go back to the k period simple growth return, the simple growth return is actually a product. Many financial analytics models require normality. So in practice, we prefer to use log return for the stock analysis.